Welcome to The Explainer. Today, we're diving into something pretty special. We're going to look under the hood of an investment portfolio that's built for one single, incredibly ambitious goal.
And that goal is this number, 20%. And look, we're not talking about a one-off good year. The target here is a 20% compounded annual return every single year, all the way to 2033.
Okay, so what does that actually mean? Well, to hit a number like that, your initial investment would have to nearly quadruple in just 7 years. So you gotta ask, what kind of machine is even designed to attempt something like that?
All right, so let's get right into the blueprint. This portfolio, it's not just some random list of stocks, right? It's been engineered like a high-performance engine with 3 very distinct, very powerful parts all working together.
And here it is, the blueprint itself. You can see how it's broken down. First, you've got this big, stable core in tech. Then, there's a pretty significant chunk dedicated to crypto for that high growth potential. And finally, this small, tactical slice of leverage. Think of it like a turbocharger.
Okay, let's kick things off with the main component, engine number 1. This is the tech powerhouse. It makes up more than half the entire portfolio, and it's basically the bedrock for this whole strategy.
Coming in at 57.3%. This part isn't about wild bets or speculation. No, this is about owning the foundational, what you'd call quality growth companies, the ones that are going to be powering the economy in 2026 and beyond. They're designed to provide a crucial safety net and hopefully deliver some pretty consistent returns.
Yeah, and this slide really gets to the heart of that thinking. The strategy is to target these mega-cap companies that are, for all intents and purposes, the essential infrastructure of our digital world. They're the pipes, the power stations, the brains, you get the idea.
Okay, engine number 2. This is the part designed to generate what finance people call alpha. And really, that's just a fancy term for returns that beat the market average. And in this portfolio, that means one thing: crypto and digital assets.
Now, this is really where the whole 20% dream lives or dies. At almost 35% of the portfolio, it's designed to deliver these massive, non-correlated spikes of growth. You know, those moments when the tech sector might be just flat.
So, and this is crucial, this isn't just one big blind bet on crypto. It's a really smart, layered approach. You've got the institutional-grade core with Bitcoin and Ethereum. Then there's a yield-generating layer with Solana staking. And finally, a slice that's betting on the emerging financial tech of tomorrow. It's diversified within the asset class.
And that brings us to the final piece of the puzzle, engine number 3. Now, it's the smallest part, but it is by far the most potent and, let's be honest, the riskiest part of this machine. We're calling it the turbocharger. Think of this as the spicy part of the dish. It's a tactical 7.9% using leveraged ETFs, and their whole job is to amplify the daily performance of the digital assets we just talked about. The idea? To turn what might be a good 15% year into a great 20% year. You know, just pushing the portfolio over that target line. But, and this is a huge but, this kind of power comes with a massive warning label. It's a critical risk called volatility decay. And what that means is, it's this kind of mathematical drag that can seriously work against you as a long-term holder if you're not super careful. And here you can see exactly how that two-sided coin works. I mean, look at this. In a clear, consistent uptrend, leverage is your absolute best friend. It just pours fuel on the fire. But in a choppy, sideways market, where the price just bounces up and down, those daily resets can actually cause the fund to lose value, even if the thing you're betting on finishes right back where it started. And that's exactly what makes it the weakest link for a 7-year hold.
So, okay, we've laid out all the components, right? The stable tech core, the high-growth crypto engine, and that very risky leverage turbocharger. The big question is, how does this machine actually rate for its goal?
Well, the portfolio gets a really strong 8 out of 10. And the reason for that score is pretty simple. It absolutely has the raw horsepower and the velocity to hit its target, no question. But it requires a very skilled, very disciplined driver behind the wheel to handle the crazy volatility that's going to come with it.
So, the final analysis is really a balancing act. On the pro side, you've got pure velocity and a pretty solid structure. I mean, it's focused laser sharp on the fastest parts of the economy, and it has that big tech safety net. But the cons, they're significant. You have huge execution risk from that leverage part, and there's a total lack of diversification outside of the digital world. I mean, there is zero hedge here if things like gold or oil suddenly surge.
When you boil it all down, the entire strategy is built on a single core belief. The thesis is that to win really big, you have to be invested in the right theme for the era. And this portfolio, well, it's betting everything that this is the digital decade.
And that leaves us with a final kind of provocative question to chew on. A powerful, long-term vision, that's one thing. But is being invested in the right decade enough if you can't psychologically and financially survive the brutal, volatile days it will inevitably take to get to that finish line? Something to think about.